Good day everyone. Today we will be presenting on MFRS134, Interim Financial Reporting. I will begin with the definition. MFRS134 is a financial reporting standard that governs interim financial reporting, which refers to reports prepared for periods shorter than a full financial year, such as quarterly reports. These reports can be presented as a full set or condensed financial statements. The minimum components include the statement of financial position, profit or loss, changes in equity, cash flows, and selected explanatory notes. The objective is to ensure timely, relevant, and reliable information for decision making. This is important because it allows investors to monitor a company's performance more frequently, not just at year-end.
During this period, 30 September 2025, the company increased its share capital. The most important point here is the Dividend Reinvestment Scheme, or DRS. Instead of paying everything in cash, the company issued over 47 million new ordinary shares. Why is this significant? This is significant because of the financial impact. It's a smart move because it strengthens the company equity base by increasing the company capital internally without needing external loan or new investor. At the same time, it helps the company save cash because most shareholders choose to receive shares instead of cash dividend. This keeps the company financial position very stable. In 2025, the company made several major dividend payments. First, for ordinary share, the company paid 4 cents per share. What's interesting here is the high reinvestment rate between 80% to 91%. This means most of the money stayed within the company. However, they still paid out about 75 million in total cash across two payments. This came from 51.8 million paid in April and 23.2 million paid in November. The impact is the Dividend Reinvestment Scheme (DRS) effectively offset the cash outflow, preserving liquidity while strengthening the capital base. To summarize, even though the company is paying dividend, the high take-up rate of the DRS shows that shareholders still have strong confidence in the company's future growth.
Second significant event that impacts Sunway Berhad financial result is the revaluation of investment properties. In 2025, the group recognized a revaluation gain of RM10.1 million. This was due to change in use. It reclassified specific assets from inventories which were held for sale to investment properties which are now held for rental income and capital growth. Under the fair value model, the assets were adjusted to their current market price. The difference between the original cost and the market value was recorded directly as profit. Looking at Sunway financial performance on SOPL, the transaction boosts their net profit by RM10.1 million. It is important to highlight that this is a non-cash gain, meaning it is increased their reported earnings for the period without an immediate inflow of cash. It also strengthens the financial position SOFP. By updating the asset value to reflect current market price, Sunway Berhad have increased their non-current asset by RM10.1 million. Next, the interim reporting period for Sunway Berhad. The company prepared the interim report quarterly. Therefore, the third quarter covers the 3 months from July to September 2025. To give a complete picture of company, MFRS134 requires to show not just these 3 months, but also the cumulative year-to-date figures and comparative data from the previous year. This table summarizes the specific dates for Sunway Berhad current and comparative interim financial statement. First, let's look at the statement of financial position. For the current interim report is as of 30 September 2025. However, note that the comparative for the SOFP is different from other statements. It will compare against the end of preceding financial year, which is 31st December 2024. Moving on the statement of profit or loss and other comparative income, here we have two reporting requirements. First, look at the 3-month quarter specifically, comparing July to September 2025 against the same 3 months in 2024. Second, report the cumulative 9-month periods on year-to-date, comparing January to September 2025 against January to September 2024. Next is the statement of changes in equity. This is reported on a cumulative basis. These are showing the movement from the 9-month period starting from 1st January 2025 until 30 September 2025. This is compared against the exact same 9-month period from the previous year 2024. Lastly, for the statement of cash flow, the requirement is similar to SOCE. Report the cumulative cash inflow and outflow for the current financial year to date, which is 1st January to 30 September 2025, with the comparative period being the same 9 months in 2024. These are the examples of the financial statement by Sunway Berhad.
I'll be giving a short and simple overview of MFRS8 operating segment. MFRS8 applies to the entities that either have publicly traded securities, are in the process of issuing them to the public, or even those that voluntarily provide segment information. The standard applies to full financial statement prepared under MFRS. In MFRS 8 Para 5, an operating segment is basically any part of the business that does three things. First, it earns revenue or incurs expense. Second, its results are regularly reviewed by Chief Operating Decision Maker called CODM. And third, component with their own financial information. This include revenue and expense from internet transaction with other segments and even startup operation if they meet the criteria. However, not every part of the company qualify. For example, corporate headquarters, research and development department, or some support function might not count, especially if they don't generate meaningful revenue. In summary, MFRS8 and the financial statement reflect how the business is actually managed.
And now I will explain the chief of decision maker, or you can call it CODM. Under MFRS8, CODM refers to the person or group responsible for allocating resources and assessing the performance of operating segment. What's important here is that CODM is not necessarily a specific person, so it can be the CEO, board director, or the senior management team, depending on who is making the key strategic decision. The CODM uses segmental reports to evaluate performance and decide how resources should be distributed across different segments. Now, moving to the example, for Sunway Berhad, based on the organizational chart shown, the CODM is senior management team together with the board of directors. This is because Sunway operates in a multiple and diversified segment such as property development, construction, healthcare, and others. Decision making is more complex and requires involvement from a group of top management. For example, they review the performance of each segment and decide how to allocate resources, such as how much investment should go into construction compared to property investment. This clearly shows that the CODM in Sunway is at a higher group level. On the other hand, for Padini Holding Berhad, the CODM is mainly the managing director or CEO, supported by the senior management team. This is because Padini focuses on retail and operates through different brands like Padini, Vinci, and C. The CEO will review the performance of each brand and make decisions related to pricing, marketing, strategy, and store expansion.
Next, I will explain the two types segmental report used in financial reporting Sunway Berhad. Firstly, business segment. A business segment is a distinguishable component of an entity that is engaged in providing an individual product or services or a group of related products or services. It is also subject to risks and returns that are different from those of other business segments. Under this MFRS, company must report revenue from external customers for each product or service. Based on the criteria in MFRS8, a segment is reportable if its reported revenue is 10% or more of the combined revenue of all operating segments. Second, its reported profit or loss is 10% or more of the combined profit. Lastly, its assets are 10% or more of the combined assets of all operating segments. If an operating segment does not meet any of these 10% criteria, it is considered unreportable and are grouped into all other segments category. Once the reportable segments are identified, then 75 rule apply. It means the total external revenue from all reportable segments must account for at least 75% of the entity total external revenue. If the total is less than 75%, additional operating segment must be identified as reportable even if they fail the 10% test until the 75% target is reached. For example, Sunway Berhad meets both criteria in their 2025 interim report. In their segmental reporting, table, property development, construction, and the other rest, these segments are reported in their own columns because their revenue and profit before tax clearly exceed 10% of the group totals. Furthermore, their reportable segment cover almost the entire group's external revenue, assuring the total compliance with the 75 adequacy rule.
Secondly, the company also provides geographical information, which refers to the disclosure of a company's financial performance based on different locations or regions. This helps users understand where the company generates its revenue and how dependent it is on specific markets. In terms of revenue by location, it shows the distribution between the country of domicile and foreign countries. For example, if most revenue comes from Malaysia, it indicates a strong reliance on the domestic market, while revenue from other countries reflects international presence and diversification. This snippet presents the geographical segmental report of Sunway Berhad in accordance with MFRS8 operating segments, which requires companies to disclose performance based on different regions. From the data, Malaysia is the dominant market, contributing 7,075,540,000 ringgit out of the total 7,493,897,000 ringgit, which is approximately 94% of total revenue. This clearly indicates a high dependence on the domestic market. In terms of profitability, Malaysia also records the highest profit after tax at 920,902,000. However, certain regions such as India and Indonesia are experiencing losses. Therefore, this geographical segmental information not only highlights revenue distribution, but also helps users evaluate market dependence, regional performance, and potential risks and growth opportunities for Sunway Berhad. First Firstly, the key benefits of segmental reporting is market dependence and revenue contribution. Part of geographical is disclosure shows how a company's revenue is distributed across different countries, particularly between Malaysia and foreign markets. From this, we can understand the level of the company's dependence on its domestic market. If a large portion of revenue comes from Malaysia, it indicates a higher reliance on the local market. At the same time, it also reflects the degree of international diversification. A more balanced revenue distribution across countries suggests that the company has a wider market presence and is less exposed to risk from a single market. Based on the segmental report of Sunway Berhad, the construction segment contributes the highest revenue, approximately 3.6 billion ringgit Malaysia, making it the main driver of the company's income. This shows that Sunway has a strong dependence on its construction segment. In addition, property development and trading and manufacturing segment also contribute significantly, indicating that the company does not rely on a single source of income. This diversification is important because it helps reduce risk. If one segment underperforms, other segments can help support the overall revenue of the company.
For second benefit, segmental reporting helps users better assess the risk and return of a company. Under MFRS8, company must disclose financial information based on different business segments. This is important because each segment operates in different industries and economic environments, which means the level of risk and return will also be different. By using segmental report, users can clearly identify which segments are more stable and which carry a higher risk. For example, in Sunway Berhad, the construction segment generates the higher revenues, considered higher risk because it depends on project-based activities, which may be affected by delay, cost increase, or changes in economic conditions. In contrast, the property investment segment shows a more consistent profit. This is because it generates recurring income, such as rental, which is generally more stable. From this, users can compare the performance of each segment and evaluate the level of risk involved. They can also identify which segment provides more stable return and which has higher uncertainty. This information is useful for investors and stakeholders as it helps them make a better decision and assess the company's future performance. In conclusion, segmental reporting improves transparency by allowing users to evaluate both risk and return across different business segments rather than relying only on overall results.